Have you been unleashed?
Unleashed.
Hey everyone, welcome back to the Horizon Advisors Unleashed podcast. This is your host, Andrew Henricks, back after a little sabbatical, but I'm here still, don't you worry. Talking about a very hot topic right now. I would say probably the most talked about topic, at least that I've had, that's not necessarily directly market related, but it is in a way market related, which we'll get to in a second. But I am joined here with my fine partner, Ryan Cuss. What's going on, Ryan?
Not too much. This podcast is the only thing in between us and our basketball practice this afternoon.
We do have some basketball practice on a Friday evening. It's exciting. It's good to get. Yeah, I'm a big believer in this anyway, but it's good to get some things that can kind of reset, end the week on a good note. Something that's fun, related with the office and stuff. So we have a little basketball hoop in our Plymouth office.
2-on-2.
That once we're gonna end the day, end the week here, play a little basketball and have some fun with some of our team members. It'll be a lot of fun. We'll keep it competitive.
Put your team together. If you're interested, put your team together. Bring it to Plymouth. We're ready.
If you want to lose, you can do that, sure. But no, jokes aside, a lot of fun. We're big basketball fans, big sports fans in general. Staying active. Don't need to labor that today. Everybody knows how important that is.
Love a good workout.
But yeah, looking forward to that too. This is that's next on the agenda after we end today. It'll be fun. But before we do that, again, hot topic. We've talked about what I'm about to say a lot of times throughout the podcast because it gets brought up a lot and it does weigh on people's decision making with a lot of different things. And that is interest rates. Interest rates.
Yeah, we haven't talked about interest rates in like probably 10 years, and we've been talking a lot this last year.
We've been talking, I would say for the last 2 years, probably every day, because it's such a big topic with inflation and the spikes that it happened, that it spiked so quickly. Now interest rates are higher and everyone loved all the low borrowing rates that they could get on their mortgages and their cars and everything. And the mortgage, obviously, interest rates gone up, and we have inflation we're trying to tackle with the Fed, and it's all about the Fed and what's Powell going to say and all these things. So it's been talked about a lot. And I'm not trying to, sound condescending on the topic because it is obviously very important. It's something that we have to look at very frequently for obvious reasons. But we're going to take a look. We're not going to talk about interest rates kind of in general today. We've done that a lot. But we're going to talk about, really it's kind of related, I think would be reinvestment risk, which is a very common financial topic and risk out there when it comes to investing. I would say that's kind of more the topic. But we kind of got this idea with the Wall Street Journal. There was an article that we'll share from Wall Street that was maybe a couple weeks ago or so that we looked at and read. And the title is Americans Chasing High Interest Rates, Risk Falling into a Cash Trap. It's by the Wall Street Journal, and the author is Vicky G. Huang. And we'll share the link with the podcast, of course. But it's a title and a topic that when I saw it, I was interested instantly because we do have this conversation a lot in review meetings or new meetings, et cetera, internally, investment committee, et cetera. And that's because we're in a unique situation with a lot of things in the economy and the market and investments and all the above and where the opportunity is, if there is any, and what's going to happen, all these conversations. And ultimately what's going to happen, we don't know, right? That's how it works. And it's just about being as strategy as you can, being diversified and allocating and taking appropriate risk when and if needed. And, essentially what we mean by this title, kind of like a cash trap, and why I say it kind of relates to reinvestment risk and some of the topics talked about in the article is really that, right? we'll start with what reinvestment risk is, and then we'll kind of go into what that topic is. And so, I guess I'll give you a layup here, no pun intended, for reinvestment risk. What is reinvestment risk?
Yeah, so before I answer that, we're in an environment where maybe you can go get a money market or a CD or a high yield, bank account, something like that. You can get, 4 or 5% interest rate. So, over the last couple of years, people that maybe had some cash on the sideline or whatever, that's, for a lot of people that have not really seen any interest on those accounts for many years, almost a decade. When you start talking about a 5% yield, it gets a lot of people interested. So we saw a lot of flows, coming from bank accounts, all different places, kind of going into these types of accounts. They're all, some of them are fixed, for a certain period of time. Some of them are variable where it's just whatever the floating rate is at the time, but you go into it, you buy into it, you're getting that 4 or 5%. You felt like, that's worth it. You put it in, you're happy. It's, pretty, not a ton of risk involved in putting your money in there. What happens when the, interest rates go down? I mean, the Feds have talked in length that they're going to lower the interest rate. So what happens? So investment, the risk is you get into, some of these rates, you're chasing these interest rates. And then over time, those interest rates start going down. The reinvestment risk comes to, what do you do with your money next? So let's say, it's not as good to put your money into a CD or a money market or wherever it was that was getting the yield. And now it's got cut in half, or, 3/4 of the yield is gone. What do you do with your money then? And is it going to be good timing to go now move it from where it was into some other type of investment? That's reinvestment risk. And I think over the last year or two, it's been super easy to say, hey, let's get that 5%, whether it makes sense, to your financial plan, to your overall goal or not, getting a 5% or 4% rate, when you hadn't had it for a long time, it's super attractive. So a lot of people went on and did that, whether it's really, to their goals or not.
Yeah, and that's a good way to put it. Kind of like another example, which you kind of alluded to, but to just kind of tackle it head on would be, let's say you did you invested in a CD at the bank, and rates obviously have not come down yet. But the topic on reinvestment risk would be, let's say you put it into a CD that was 1 year long, and you got it at 5% or whatever it is. Let's just keep it simple and say it was 5. So if rates go down during that time frame, right, of that year long, and then when it comes time when your CD matures and now you can get the same one, or it's going to be reissued to you now automatically if you don't opt out or whatever way they do it, but now they're offering at 3. Well, you instantly go into the 3 and now you're back down, so now you're at a lower rate. And that, where it comes down to is that really what you wanted? Is that money, should have that gone somewhere else? Should you have done something else with it? Would you have done something else with it if you knew that was going to happen? Those sort of things. That's the kind of risk you have in fixed instruments that relate and are directly tied to interest rates, because they have all these different kind of metrics and levers that are behind the scenes are affecting what's going on. So yeah, during that span of time, if the rate went down and then you're still locked in that higher rate and you get that, great. But the environment, the economy, the market, whatever, is going to be different.
It's always changing.
Always. So it's going to be different at the time when that CD or whatever matures or is done. And then, like Ryan said, what are you doing with it at that point, is kind of some of that risk that's associated with it. And the one thing that I will state on the title of this article, which is kind of about the cash trap, and some of the things that we have seen, is because the interest rates, they're chasing, it feels good to have that money market liquid, all those things, and that's all great. Liquidity, emergency fund, we've talked about those things. You have to have those things. That's not the point of this conversation. That's a separate conversation. All those things are important, but people have been falling into this trap because instead of for their long-term goals, their financial strategy, the things that they have been doing that is working towards their long-term goals, they've been falling into that trap in the short term and say, instead of doing what my long-term strategy says I should do or the strategy that we committed to and have been doing, I'm going to change that now because, I can get 5% in the bank and in the yield, I can get that. So I'm going to shift and do that instead, which for some people, maybe that has been the strategy all along and they have been doing that. And then now they're just getting better rates than they did before. That's great. But this trap that we're alluding to is that many people have shifted their long-term goals and their strategy that they have been doing because of this reason.
Pick up the easy yield.
Correct. When in reality, they probably should still be doing what they were doing before. Again, everyone's situation is different, so maybe something changed. But for a lot of people, they shifted that because they feel, I can get this yield, it's comfortable, whatever. But when you look at it, especially at least over this last period of time, the market has still gone up.
Yeah, the stock market's done decent.
And
during
again,
this time.
it goes up and down. So full disclosure, it goes up and down. Yes, we know that. But you look at the people who chase the rates. If your strategy was to continue to invest in the market, the S&P, whatever it was, and you shifted to the interest rates over the last year,
or you got some new money,
Mhm.
somehow through a bonus or an inheritance or however you got it. And instead of, again, going for, what are my goals? What is the purpose of this money? You just went to the easy way. Hey, I can get 5%, 4%, doing a CD. That's where the problem of reinvestment risk can happen.
Correct. And that's where chasing these rates can be a problem sometimes. So I guess kind of the point of this conversation is really to when situations and financial markets, they're always changing, like we just stated. So when those things change, yes, it's always prudent and important to be considering alternatives and looking at the plan and making sure that this and that and your strategy is still working towards what you're trying to accomplish. You should be doing that regardless. But when things are changing like this and things seem easy or things are, there and I can get that does not justify always that you should do it. That doesn't mean just because you can get the 5% in the bank, the money markets, the CDs, that you change your strategy for that reason. If it was done because of a thorough process and all those things and you talked about it and that's what you wanted to do, then sure, maybe that is the right thing to do for you. But simple like for like, that's the trap that we're talking about. And that's what the banks want you to do, believe me. They're feeling, you see all the billboards now, all of a sudden you see them going up. All the advertisements. Oh, open up account, get 4.5%. Open up an account, get 5%.
Oh, they're
open
filling their coffers up big time.
You know
right
what they're
now.
doing, right? I mean, so you got to really look. You got to look a little bit deeper, and to truly understand what's going on. I think the banks just had record earnings, right?
Yeah.
So think about really
Well,
what's
it's
going on.
because they can do stuff with the deposits. I mean,
Yes.
if you get a CD and you're locking in for a certain period of time,
Mm-hmm.
they're going to pay you your interest rate more than likely.
Mm-hmm.
And then they're going and doing something different with that money,
Correct.
maybe packaging it in a loan or doing
Mhm.
this or that and trying to create
Yep.
an arbitrage where maybe they're making,
Sure.
1% or 2% or whatever it is,
Yep.
off of your deposits.
Yep, they're packaging it up into mortgages or other things, and that those mortgages are 6.5%, 7%, whatever it is, and you're locked in at 5%, and they're using your deposit, pay you 5%, and they get 7%, whatever it is. There's
Yeah.
the spread, right? And that's how banks work, which is nothing wrong with it. That's how banks work, and that's how they're useful, and it's great. There's nothing wrong. There's nothing wrong with the banks. I'm not hammering them, but you have to look again that it's about the trap. That's what we're here to talk about, right? And it's more of like a behavioral, emotional type of a trap sometimes where you convince yourself that it's the right thing to do because it's a good yield and rates are high and those things that's what we should do. But a lot of the time, if you fall in that trap, you're actually hindering your long-term goal, which is changing the strategy that was working and is working and should be suitable for you long-term.
Yeah, I think everybody, for the most part, if you had emergency funds, that were adequate, if you had short-term savings goals and maybe prior to that, you said, "Oh, screw a savings account. There's no interest now. I'll just throw it all on my checking." I mean, I knew tons of
Mm,
people, with big balances on their checking accounts. And for those people, totally makes sense. Go get that yield. If your money's still liquid, or if you do a CD and it matures within the time frame you need, that totally makes sense. Make those dollars that you already had saved work better for you.
mm-hmm.
Totally makes sense. But, again, if you're changing your investment strategy, maybe you're even selling out of stocks and bonds and other things to free up the money so you could put it, in the money market, that might not work out the best for you long
Mm-hmm.
term.
And yeah, so and I totally agree with what Ryan said. That's definitely a good point to make. Is that's why you just have to look at the situation and then try to avoid this trap, because these rates in this situation that we're in is very beneficial in for that certain strategy, for that circumstance that Ryan just stated. It's about the other things that you have to really just ensure that you're making the best suitable financial decision for you and your goals. Another piece of this reinvestment risk when we relate to the interest rate environment that we're in is sometimes people, if we're looking at fixed income, right, which is what fixed income is generally it's considered conservative investing. That's what the term is. It's generally considered there is
It's
risk
more
associated,
stable.
but it is on the conservative side of investing. Well, you can, in that conservative side, when you get to short term type of investments, which would be like CDs and liquid type of money markets, bank notes, those sort of things, a lot of the time, depending on time horizon too, but you also can include bonds into that metric. Usually those are a little bit more time horizon and other things, but you can get short term bonds, etc. Purpose of it today is not to talk about bonds, but the very common financial topic, which you have seen if you look at the bond market over the last couple years because of interest rates going up so quickly and fast, is they're inversely related. So the bond prices will go down as interest rates rise, and vice versa. When rates go down, bond prices will go up, right? So they work inversely related in that sense. So my point is, again, is if you change your strategy and maybe you have fell victim to some of this trap, and instead of reinvesting into the bond sector that you normally do, and that's the strategy that you have because you're going to go to the cash and get that yield now, there will be a tipping point at some point of when that happens. We don't know. But when the rates do curtail down and maybe the bond prices increase, well, you've already missed that point. You maybe got the yield and you got
The coupon.
yeah, right, that you had, but now you've switched over to something that does not fluctuate with interest rates, which maybe is a CD, right, in terms of the actual price, the value of it, because you're just getting your declared rate no matter what, right? So that's also something to consider, because if rates do come down, that's also part of the reinvestment risk that you may have if you were switching between those instruments, that you would lose out on.
Yeah, where do you go then?
Where do you go? Because the bond prices would have already appreciated at that point if rates go down, right? So now you held in, oh, the rates are down. I don't want to go back in the CD. I don't want to go back in this cash. Now I'm going to go back into my bonds. Well, now you might be buying bonds at a premium.
Yeah, it might not be good timing.
Yeah. So that's another example of some of that reinvestment risk that we're talking about, and also alluding, again, to part of this trap. So,
And that trap, once you get in there, it might sucker you in for
mm-hmm,
decades. If you play that CD game, I mean, I
mm-hmm,
know tons of people, that were playing CDs for the last 10 years. I mean, they were
mm.
scraping, 1% if they were lucky getting that on a CD. And if you get stuck into that, game for a long time, you're probably going to be a little behind on that money.
And at the end of the day, our job here is to educate. That's what we're here to do. This is what we talk about. These are the things that we're looking at a daily basis. Nothing is, no matter what we say or what we do, is going to change the fact if you are convicted on your reasoning and you are super, super conservative and you want to be at the bank and you want to be in cash. At the end of the day, nothing we say is going to change that. And there's nothing wrong if it's working for you and it lets you sleep at night, and you're a good saver and all these things and you're okay with that expectation. There's nothing wrong with that. We're not downplaying that at all. All we're saying is just alternatives and consider what's actually going on, and why working with a professional like ourselves, these are the conversations that we will at least bring up to you. right? Because that's our job, is to question.
What's the purpose of this money? When do you
Exactly.
need it?
What's the purpose?
What do you want it to do for you?
And that is what comes down to really the question. Because if we go back to our primary example of, okay, maybe your strategy was you were investing in the stock market and then you got a little nervous with 2022 or whatever it is, and now you've got these rates here. Oh, I can get this yield and I'm okay. If we go back to that example, right, and you look at that, that's something that, as long as you've had that conversation and you asked and you talked about it, if you're okay with that expectation, that's fine. But our job also as professionals is to make sure that your long-term goals are intact. And yeah, you might have felt a little bit of pain by, continuing to invest maybe in equities and other things that went down. But in the long term, right, if that is the strategy and that's the conviction of what you're working towards, sometimes you have to eat some of that pain to continue to have that long-term strategy intact.
Yeah, it's never just a rocket
No.
ship straight up when you're investing in the stock market.
So don't feel, I guess my point is don't feel if maybe you've stayed with your strategy and maybe it didn't work for the time being.
You're like, hey, my stocks didn't
Yeah.
even do 5%. They lost money. I could get 5 in a CD, Ryan.
That's a short-term mindset, because you're not looking over the time span of what the goals are. A CD is a short-term, that's what it's for. You're comparing a short-term goal to maybe a long-term goal or strategy. So you can't directly relate those either, unless you are really opting to change your strategy and had that expectation and understanding. So we want to do this podcast and talk about these things because these are real things that, from a financial standpoint, can make a difference. And like Ryan said, you can get stuck in that trap, and then maybe over the next 5 years you just kept rolling the CD, and maybe let's say you got 4% over that span of time. After all the rate changes and all the reinvestment that you did, you got 4, right? But you'd have to compare over the next 5 years what the alternative did. And if you opted for that strategy when in reality the other one was more suitable, that's something that you're going to have to be okay with if you do decide to do that option, right? These are things we're talking about every day. They're very important for your goals and for planning. And that's where the planning really comes into play and I think is extremely valuable.
Helps you make those decisions. Should I put in? How much
Correct.
should I put in? Well, it's all based on what you want to have happen. If you don't need to touch this money for 10 years, probably being in CDs or money markets is probably not the best place for you.
And some of this stuff also has to do with other behavioral finance metrics and qualities, characteristics like the herd mentality and things like that, right? If you see all the billboards and you hear, oh, your cousin, your brother, your sister, your friend, your neighbor, whoever, oh, I just locked in mine I got 5.5 in a CD for a year. That's a smart decision. You should really consider that. That doesn't mean that works for you. It might work for them, and maybe they had sound reasoning and it makes sense for them.
Or maybe they had no reasoning.
Correct.
And they just like that
idea.
They like to talk about it.
And they think that they know. And that, so you have to decipher some of that too. And that's where sometimes also having a professional team to remove and just focus on rationale and remove emotion and some of the other stuff can be important so that you can potentially avoid some of these traps that happens. And these aren't the only ones, right? This is just an example, but there's traps on the other side too, right? Of all the other things we mentioned that you have to be aware of. And that's part of our job as well, is to educate and be looking for those traps. So I think the ending kind of part of this is just to, if you are utilizing these instruments to invest and save money, really focus again, that word purpose, the purpose that we mentioned. Is this money, meant for the cash, the liquid, the short-term investments, the conservative? Is it meant for that? Or am I really now changing my strategy and repositioning into something where that was really never where this money was supposed to be in the first place? I'm trying to hit other goals. Those are things you have to consider and just watch out for the traps that, that can happen in this regard. But a great topic, definitely one we talk about a lot, and more recently, of course, because it's kind of like that hot topic. But like we always say, take a look out for it. And if you need to, reach out to a professional like ourselves for guidance. That's why we're here. Thank you very much. We enjoyed it. We'll see you next time. Ryan Cuss, President and Financial Planner. Alexander Dinzer, Managing Director and Financial Planner. Andrew Henricks, Financial Planner. Securities and advisory services offered through Cetera Advisor Networks, LLC, member FINRA/SIPC, a broker-dealer and registered investment advisor. Cetera is under separate ownership from any other named entity. Tax planning services offered by Horizon Advisors. Tax and accounting services provided by Horizon Advisors CPA. Cetera Advisor Networks does not provide tax nor accounting services. For a comprehensive review of your personal situation, always consult with a tax or legal advisor. Neither Cetera Advisor Networks, LLC, nor any of its representatives may give legal or tax advice. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks, LLC, and should not be construed directly or indirectly as an offer to buy or sell any securities. Due to volatility within the markets, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. A diversified portfolio does not assure a profit or protect against loss in a declining market. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59.5, may be subject to an additional 10% IRS tax penalty. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal of earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59.5 or due to death, disability, or a first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes. Investing in mutual funds is subject to risk and loss of principal. There is no assurance or certainty that any investment strategy will be successful in meeting its objectives. Exchange-traded fund and mutual funds are sold by prospectus only. Investors should consider the investment objectives, risks, and charges and expenses of the mutual fund or ETF carefully before investing. The prospectus contains this and other information about the product. Contact Alexander Dinzer at 5455 Corporate Drive, Suite 306, Troy, Michigan, 48098 or 248-265-6662 to obtain a prospectus, which should be read carefully before investing or sending money. Horizon Advisors, 5455 Corporate Drive, Suite 306, Michigan, 48098.